Hey everyone, it's time for another episode of Mayhem in the Markets, coming to you Sunday, December 18th. We're going to talk a little bit about what's going on in the world out there. But first, I wanted to make you aware of a very special promotion. TraderAid is giving 30% off any plan at TraderAid.com. Just use the coupon HOLIDAY2022 anytime before January 2nd, 2023, and you can get 30% off. This is our best sale all year long. So be sure to check it out if you haven't already. And if you're existing on a plan already, you can use this coupon and set the start date of your new plan to end on the same day that your old plan does, so that way you can take advantage of these savings. First chart I have here is the S&P 500 looking rather precarious. The index has fallen below the 200-day and 50-day moving averages and has been repeatedly rejected at the descending trend line going back to the start of 2022. This is a big deal, by the way, because this trend line has been honored so well through and through. And we've seen it rejected 4 times now. The first was when the trend line really started to be built, right? That was the top that we saw in the early part of this year that marked the ultimate top of the prior bull market. But then we saw this play out 3 subsequent times, including recently. And what this is telling me is that the market doesn't want to move past this. It's really putting in very clearly a series of lower highs and lower lows. And each one of these rallies has been predicated on false hope. The idea that the Fed was going to come to the rescue, that there wasn't going to be a protracted economic downturn, that corporate earnings would be able to persevere through such a difficult environment, that inflation might be transitory. Nevertheless, what we're seeing is the reality, which is that this has been a rather long and unforgiving bear market. The last bear market rally, I think, is ending. And I believe that's what we started to see over the last week, where we also fell below the 200-day and 50-day moving averages and the trend line that goes back to October 12th, 13th. You can kind of ride that trend line all the way up till last week when we cut just right down below it. It's not on the chart, but you can draw it yourself if you want. Nevertheless, with all this selling, the RSI is still not at oversold levels, and we're not seeing any oversold indicators elsewhere in the market, except for extremely short time frames that are much more appropriate for day traders than swing traders or investors. So to that effect, we're looking at the New York Stock Exchange McClellan Oscillator. It tends to be oversold around -80. Right now, it's at -50.52. The breadth of selling has been increasing, with most sectors and factors seeing drawdowns last week, except energy, of course. And so, energy's been resilient. The sector's up over 60% year to date if we look at the XLE ETF. And it's been the most aggressive performer because, we had a nice run in oil up to June. But at this point, parts of the energy complex are actually starting to look just a little bit expensive because of the degree of operating leverage these companies employ. They are more sensitive to the price of oil. So while it's great for the price of oil to be above 40 or 50 bucks, the run here may be getting just a little bit long in the tooth if we don't recover above 80 pretty soon. That's my opinion. I could be completely wrong. Managed money is really bullish. The last time they were this bullish was in August, and we know what happened next. The market fell over. Now, that doesn't mean that past is prologue, but what it does tell us is that we're at risk because how much more money is left to put in the market. Retail households are still pretty close to the most long they've ever been versus their entire net worth, and we're seeing managed money start to get more and more bullish as well, which concerns me because they've been wrong every time this year when they've gotten this bullish or more. The market has rolled over. We can see that with each episode. The beginning of 2022, spring, summer, and now winter. It's almost like we have bear market rallies for each season of the year. And the options market is manic. Look at that. Since November, we've seen some of the most extreme ranges ever in the CBOE equity put call ratio. We've also seen the highest put call ratio since 1997, which is alarming because it's telling us there's these extremes in positioning, changes that are happening on a near day-by-day basis, as we can see with this violent up and down volatility. It also tells us that a lot more of this options trading that is near dated is having a big effect skewing these statistics. So how much noise there's in here, that's a good question. It's probably a fair amount, but nevertheless, these reversals between highs and lows have been nothing short of violent and extraordinary, and all this options-driven activity becoming the tail that wags the dog is adding to market volatility. Bulls versus bears. We're looking at bear markets and bull markets going back 96 years. This is pretty interesting. The average bull market returns 162%. The average bear market loses 41%. Bull markets tend to last about 4 years, and bear markets tend to last just shy of 2 years. So if past is anything like the present, we've got more downside and more time. Now, obviously, there's no way to know that for certain, but I think given what we've seen with the Fed being rather unforgiving, saying they need to keep hiking us even into a recession and through it until inflation subsides, and that they're concerned about wealth effects and the looseness of financial conditions, that's giving us a sense that they've got more work to do, and they know it, and they're telling us. This is the most transparent Fed we've ever seen. They're telling us stocks, bonds, real estate need to go down further. Oil, eggs, airfare, and butter. What do those four things have in common? They are the biggest inflation movers from January through October, and this is pretty crazy, because you're seeing this distributed across so many different areas of the economy, as you can see in this chart, but also in things that everyone needs. Like this winter, everyone needs fuel oil. A lot of people eat eggs, margarine, flour, salad dressing, canned fruits, and pets need pet food. All those things have risen in price, so have more discretionary expenses like airfare, necessities like public transportation. Of course, speaking of heating, utility pipe, gas, these are all things that are very important in the sense that there is a mix of staples and necessary services, and even vacation to some degree is important, right? Without vacation, people start to go a little crazy. So I want to look at this chart with a little bit of nuance, because what it's showing me is that the prices have risen such that even if the velocity of inflation falls, even if we get to PCE or CPI of 2 to 3%, it's still, the prices are just too high for most people. Even with a lower rate of inflation, without prices dropping, a lot of people will struggle unless somehow their wages rise, which is the antithesis of what this Fed wants. And this Fed is hawkish. The dot plot was revised meaningfully higher, suggesting a terminal rate of at least 5% and possibly an upper bound rate of 5.25%. The Fed's SEP was more hawkish than the market expected as well. This is from it, of course, the dot plot. And their statement, as well as Powell's press conference, really drove that message home. The market is continuing to digest this reality versus more dovish expectations, and I think that's something that we need to keep in mind as we move forward, that it typically can take several days to a trading week for the market to really price in what they've heard from the Fed, if indeed the market believes the Fed. And the Fed is the market, as are other central banks, as we can see this strong positive correlation between the total assets of the Fed, ECB, and Bank of Japan versus the S&P 500. And so as the Fed draws down their balance sheet, we can see the market's path of least resistance is lower. Similarly, as they were engaging in unprecedented amounts of quantitative easing and other forms of monetary stimulus in the form of zero interest rate policy, or in the case of ECB and BOJ, negative interest rate policy, we could see that positive correlation between the expansion of balance sheets and stock performance is also true. So this tells us that as long as central banks are tightening, in particular running off their balance sheets, it's likely that we're going to see lower lows ahead. But when we do reach the ultimate bottom, the rally could be huge. The average 1-year return after the market puts in its lows is 41.1%. The average 2-year return after such lows is 57.9%. So that bottom, when it does happen, is going to be a real face-ripping rally into the new bull market, the rally that no one believes, the rally that leads us to that new credit cycle, that new bull paradigm. And the last chart I have for you, will tech continue to dominate as we get into the next cycle? We're going to have to ask ourselves this question. We've had basically 10 years of tech dominating. Is that going to be the theme moving forward? I don't personally think it will be. Most bull markets are led by different leadership. I think the next time we're going to see more of a bull market led by cyclicals out of necessity. Materials, energy, agriculture would be my guess. Other areas similar to that. But we'll just have to see what happens with these very large mega cap companies, which make up the top 4 of the top 5 largest publicly traded companies in the world. So this has been Mayhem in the markets. I hope everyone has a great trading week ahead. Don't forget to check us out on TraderAid.com. That 30% coupon is Holiday 2022. Hope to see you there.